All right. Let's go through a quick sketch. First of all, what's going on in the total U.S. economy, then a manufacturing emphasis within that. Then we'll get into details into how Wisconsin's economy is performing, and particularly how Wisconsin manufacturing is performing. There we go. Let's try that one. That should work. Does everybody see the appropriate title? It references UW-Stout, I hope. Trying to share screen. All right. Heidi, you just give me a thumbs up. Do you see it? Okay, there we go.
That is it. Right. Thank you.
That's what I need. All right. Let's go through a quick sketch. First of all, what's going on in the total U.S. economy, then a manufacturing emphasis within that. Then we'll get into details into how Wisconsin's economy is performing, and particularly how Wisconsin manufacturing is performing. The headline there, which is probably appropriate, says, headlines don't tell the full story. If you are focusing on a single number, you can actually miss what's going on. Right now, you have a situation that macroeconomic tools are sort of working at cross purposes. On the fiscal side, it's stimulative. On the monetary side, it's restrictive. As a result, you're having a situation that the economy is both strong and weak at the same time. It all depends critically on the industry you are in. Particularly, those industries that lagged during COVID are now leading. Those industries that led during COVID are now fading. It all depends critically on the industry and location. Sometimes even within an industry that's fading, if you're picking up market share, and I think there are cases of that in Wisconsin, you would still be seeing positive numbers. Overall, the Wisconsin economy exhibits considerable strength and resilience in a challenging U.S. economy, and the good news is often unmentioned. Now, when I say mixed signals, let's illustrate it. First of all, these are two high-frequency measures, and high-frequency measures is a nice buzz term, which means we report much more often than quarterly, that we do so on a weekly basis or even sometimes daily. But the two indices are giving you different results. On the top in green, it's the New York Federal Reserve Bank Weekly Economic Index. They are highlighting that overall the pace of the economy is almost 2%. On the flip side, the U.S. Census Bureau Index of Economic Activity, basically on the strength of a weakening of orders in manufacturing, has moved to the point it's negative to about 1%. Not to be outdone, what's displayed here is the reports on the state of the economy issued by the Institute for Supply Management. And they give completely different reports. If you're on the service sector, they're showing continuing gains, suggesting a 1% increase in real GDP. On the other side, on the manufacturing index, that's been down now for like 14 consecutive months. It corresponds roughly to a 0.7% decline in real GDP. Now, not to be outdone, we'll take a look at the data that the federal government's actually reporting for those who actually monitor what the pace of the economy is. The real gross domestic product in third quarter grew 5.2% over second quarter, and on the year it's up 3%. Those numbers sound great. On the other hand, if you look at domestic income, that is to say, who's getting paid to produce things in the United States, as distinguished from we are buying things from someplace else, the real domestic income numbers are not nearly as strong. In particular, in third quarter, real domestic income increased basically 1.5%, not 5.2, but 1.5. And year over year, it was actually showing a decline, basically, especially in real terms, because inflation was so strong. So how did we get here? First of all, there is a series of things that I consider to be standing on the throttle, things that are basically keeping the economy going strong. Number one of which is the U.S. fiscal policy. Past efforts to release the pandemic are still working in the economy. And not to withstanding, Both increased federal spending is underway, particularly in infrastructure, and state and local governments' cash holdings now permit added spending or tax relief, or both. We had, if you'll recall, 3 rounds of stimulus funds that were distributed to individuals and support for proprietors. Both of those had, and they were, basically May 2020, then January, and then again in March 2021. This huge slug of funds came all at once. And the question is, where did the money go? Very little of it actually went to current spending. Most of it went to either pay down debt or to increase savings, suggesting that a lot of what that stimulus money was going to go for is still impacting the economy now, as we can demonstrate. You can see what happened when the federal government sent out those checks. There was these huge spikes in savings. And you'll notice very high, but if we were to pay very close attention, you'll know right now the savings rate isn't what it was before the pandemic, in part because there was so much cash in hand that consumers are able to continue to eat into prior savings because people were sending you money, you didn't have anything to buy. Now we can actually go ahead and do so to maintain a standard of living, and that's actually what's happened. We had basically an accumulation of about $2.3 trillion, of which consumers are now spending down those excess savings to support consumption. In other words, you can spend more than your income generates. Overall, household debt service crashed out of revised data that was released last Friday, so I had to update this one yesterday. Household debt service has returned to pre-pandemic levels, but it's mainly on the credit card side. On the mortgage side, it really hasn't. We're basically still running below pre-pandemic levels for mortgage debt service. And if we think of that debt service as a percentage of disposable income, you can see the sharp contrast where we were coming out of the 2007-9 housing crunch, where mortgages were hitting 7% of income. Now it's below 4%. And in particular, on the right side, in the red, one of the things that's happened that allows the spending to continue is what happened with all of those folks, and I'll plead guilty to this myself, that refinanced their mortgage. Basically, the amount of mortgage rates outstanding on existing mortgages is way below pre-pandemic levels, and you can see where once upon a time, beginning the century, you were spending about, the average effective rate on outstanding mortgages was 7.65%. Now it's only 3.55 because everybody that refinanced are paying 2.5, 2.75 on their mortgages. And even if mortgage rates are at 7% or so for a current mortgage, on outstanding mortgages, it's less. That frees up money to support spending. Now, for the longest time, and this did impact up to the third quarter data, another form of consumer finance that was supported through all of the stimulus funds. Under the original CARES Act, student loans were basically in forbearance, which means basically you don't have to pay us anything and we're not going to charge you interest. Originally designed to last 6 months, it was over 3 years. It's only recently that student loans have begun to be repaid. And you can see basically on that nice right chart, only about 7% of people that had student loans actually were engaged in paying them back. The amount of repayment in billions of dollars is going to go up, and that's actually will flip from stimulative to restrictive coming forward. But where we're going to see big changes, and I highlight this one in particular, because as you look at some of the data, both on construction spending and manufacturing, we're seeing impacts because of this. The infrastructure bill was a substantial increase in spending authority for bridges, water supply systems, highways, alternate energy development, etc. Those outlays are ramping up, even if we've already had it passed substantially in 2003, more spending authorized in 4, 5, 6, and 7, but the ramping up of the outlays is going to proceed over the next 5 years. Similarly, the Inflation Reduction Act really was designed to support, in the short term, alternate energy projects with reducing federal spending 5 years out. In the interim, it increased federal spending through to 2027. As a result, federal spending by itself is expected to be up a cool $1 trillion annually through 2031 than it was compared to the path of spending in 2021. Part of what goes on there is you had this big increase in funding supporting state and local governments. The two big spikes there, of course, related to the stimulus funds as well, much of which was targeted to school districts and local governments. But even on a continuing basis, federal grants and aids to state and local governments are running 50% higher than they were pre-pandemic level, suggesting that they can continue to spend in part because you have the federal funds, even with the debt ceiling negotiations that was suggesting some clawback. There are balances held particularly by school districts of those stimulus funds that can still be released, and now the pressure is to spend them or they would be clawed back. State and local governments were in a situation that, because of the surge in revenues at a time when they ramped down spending anticipating a collapse, general fund cash balances across the country were record highs. For us, we did hit a record high of about $7 billion, and our stabilization fund was topped off at $8 trillion. One of the things that has happened, of course, if you have those kinds of proceeds and you have that kind of mismatch, you can redesign your budget to actually share some of the wealth, so to speak. That has happened with one of the initiatives to increase funding for counties and municipal governments in this state. In addition, we had about 3 other forms of tax reductions, one of which I will highlight when I get to the appropriate part. Now, the next part of what I call standing on the throttle is labor markets still remain tight. Overall, much like you were getting mixed signals, there are some mixed signals in the labor markets. In blue on the left side is the headcount for establishments. That's basically, you survey establishments, what's the headcount, how are they growing in terms of the overall pace of hiring. The overall pace of hiring has slowed down slightly over the last 12 months, where we were running at about 300,000, we're running at about 200,000 month over month. But if we go to the right side, you'll see the household survey isn't quite as strong as that, because we had several months where we had declines in, and this is my emphasis here, full-time employment. Much of the gains that we were getting on the establishment side is as we sort of return to restaurants and food services being open, arts and entertainment being open. Much of those gains are sometimes in part-time employment. The overall gain in full-time employment is at a much slower pace, and it's really over the last 5 months. I'm sorry, that's 7 months there. 4 of the last 7 months actually reported a decrease. Where you have considerable safety margin for the labor markets is the extent of job openings. Coming out of the pandemic, job openings at one point hit a total of about 12 million job openings. It has faded. Basically, the number of job openings, sort of as your first resort if you're facing a challenging economy or you've been successful in recruiting, pick one. You have a situation that the number of job openings will be compromised before you would actually think in terms of actually laying off. And in particular, if you've had a hard time hiring, you're probably not going to retreat from that because you're dealing with such a competitive labor market. In this illustration, the 2019 average is the black line. Basically, for years, job openings across the country was about 7 million. Even with a decline of over 3 million job openings, we're still 1.7 million ahead of what you consider to be pre-pandemic openings. And it depends critically, again, sort of where I highlighted at the beginning, it depends on which industries were adversely affected by COVID and where they're at in their recovery. Where you were really lagging is where you're seeing the most acute shortages, particularly healthcare, accommodations, and food services, to a lesser extent transportation, and that transportation is probably not trucking, but airlines. As a result of all of this, any place where you've had the biggest shortfalls in terms of job openings, That's precisely the place where you're getting the biggest wage pressure. The other subtle thing about the graph on the right that is not difficult, is a little more difficult for me to illustrate cleanly, so I'll just array it. There's actually been a convergence, whereas about a year ago, there was sort of a steeper pattern of some industries were having very low wage increases and some industries very high. You're actually seeing sort of the overall average now drift to about 4.5. Only the ones in red are above that. But whether it's manufacturing's at 4, only whereas before certain services were down in the 2 in the utility section, for example, everybody's sort of had to compensate for recognition that wages needed to catch up with inflation, and the overall average is getting closer and the disparity is tightening, which comes to me inflation. This is actually a setup for when I discuss what's going on with monetary policy. For calendar year 2022, inflation was the highest in over 40 years. Highlighted in red are only those years for which inflation was above 8%. It's rare. We basically went 40 some odd years, almost 2 generations, before we had inflation, what we saw in 2022. As of this morning's release, consumer prices have now declined to about 3%, but that is still well above target. And the other of which is the more germane part and is relevant to the part that I was making about wage increases. The core inflation rate, which excludes the price of food and energy, is still running at about 4%, largely because services are still running very high. And at 4%, that's twice what the Federal Reserve's target rate for inflation is. And if you look at that black line, which is 2%, you can see basically we went over 20 years with inflation rate in that average pretty tightly. And the surge that we've had since coming out of 1982, we backed down to it, but we're still running basically ahead of where we were even 30 years ago. In part because this has not been updated for today's release, but at least current to last month's. Where the biggest cost increases are that impact most people is on the shelter side. That is to say, what does it cost to buy and maintain a home? What are rents? Energy is keeping the overall all items index down, but the all items excluding food and energy is up, and anything to the left of that yellow bar is actually running ahead of even that base inflation rate. This is where it now matters relative to wage setting. Real wages actually declined for 7 consecutive quarters when inflation was running hot. Only now are we starting to get real wage increases. And if you consider what's going on with the UAW settlement, and I want to say it's the FedEx settlements, there is pressure among employers to compensate for some of those earning losses. As witnessed, there's a lot of ground to recover in terms of private wages and salaries. We basically lost and went back to levels at this point of over 6 years ago after such a sharp decline. As a result of all of this inflation, though, this is what the end result is. The Federal Reserve moves to a restrictive monetary policy. Overall, the money supply has been shrinking since December 2022, basically as a result of quantitative easing, where the Federal Reserve would buy securities, particularly in this case, a rare item, mortgage-backed securities. It buys the securities, hands over cash, puts it in the system. They are now holding it to maturity. So as those bonds come due, they basically take the proceeds and hold it. So gradually they're moving money back out of the system after flooding with it. Back in the 2020 period, you saw increases in the money supply that was completely unprecedented. Since 1913, it's never been that high. And now we're in a situation of it shrinking. Not the least of which is the Federal Reserve increased short-term interest rates by about 500 basis points since February 2022. Highly restrictive very quickly. Real interest rates have only turned positive in the first quarter. When they first started raising interest rates, inflation was running so high they had a lot of time to catch up. They've now moved back to the stage where roughly you would need to be if you're going to try and restrain the rate of inflation. But in a sense, if we think of 4% as the core inflation rate and 5.3% as the average federal funds rate, in real terms, it's only 1.4%. And it's only recently we've actually gotten to that stage where it's been positive. Short-term interest rates have actually risen faster than long-term interest rates, which sets up this lovely headache. The yield curve is now signaling a contraction. Basically, anytime you have long-term rates above short-term rates, let me rephrase that, short-term rates above long-term rates, that is a signal, sort of like a barometer, signaling there is an effort to restrain the pace of the economy. And right now, that's a strong negative outlook because the difference is over 100 basis points between the two interest rates. Overall, the Federal Reserve Bank of New York and Cleveland track it as ways to predict a recession. And it's not that the yield curve itself causes it, it's what happens when you raise interest rates. Number one of which, of course, is auto loans become more expensive, so cars are less affordable. Interest rates assessed on credit cards go up, so more money is spent servicing the interest than on current spending. Mortgage interest rates hit the highest level in 23 years. Bank prime loan rates say the same thing. And in the right-hand case with the prime rate, if for businesses that had balloon notes that are coming due, they're not going to be refinancing in an interest rate environment of 3.25%. They're going to be refinancing in an interest rate of 8.5%. Okay, did that. Well, if you have rising interest rates, here's the shock. People actually have to spend more money paying interest. And again, in this case, if it's up 190 billion compared to where it was last year, there's 190 billion in spending that goes to service debt and doesn't actually buy anything in the current quarter. It pays for things that were previously bought. And the next part, of course, if you have higher interest rates, it affects the affordability of major purchases. On the left, it's the index of how many weeks does it take of income to purchase the average new light vehicle. It's now 42 weeks, up from about 34 weeks, actually 30 weeks at one point. And the housing affordability index is at the lowest level it's ever been. Basically, in this indicator, it's 100 if the median family income can afford the median valued house. We're down to around 60%, so probably less than 2/3 of families could afford to buy a new house if they needed to. Next, of course, is anytime you're having rising interest rates and seeing how it's affecting balance sheets, bankers are tightening lending standards. So both changing standards in a tighter fashion compared to even roughly a year ago. Early 2022, nobody was tightening standards. Now about half the banks are. Not the least of which is credit lines are showing considerable tightness. This is roughly the flight plan for the Federal Reserve. They're basically signaled as of September they might even have a quarter basis point rate increase yet. Maybe they won't, but they're not signaling big increases through between now and 2024. And in particular, pay attention to that core inflation slide. We're exactly where they wanted us to be. They were expecting a decline by the end of 2024 to about 2.6%, but if we're locked in at 4, because we've hit, you're not there yet. Now, housing and construction. And I'm going to talk about construction and retail sales before I talk manufacturing, because when I get to the manufacturing sector and different results, you'll see some of the considerations for this mixed results are apparent in other industries, and if manufacturing serves them, they are affected. Overall spending for non-residential structures have actually started increasing again, but construction spending on private residential structures have not. And even in the residential sector, there is a divide. It's the single-family homes that have declined sharply. Multifamily housing has actually been increasing. On the commercial side, it's basically a buildup of warehouses, not so much hotels. Housing, office construction at best is sideways. There's probably going to be a drive to convert existing offices not being used into housing structures later. Overall investment in energy generation, whether it's gas and oil or electricity, is actually not going up, it's declining. Where we're getting big increases is exactly where I was highlighting relative to the infrastructure bill. State and local construction is going up substantially, largely on the basis of infrastructure. The big one that drives it, though, is actually manufacturing construction. Manufacturing value put in place has reached a record high as an expanding. Indeed, if you look at the data on non-residential structures, it's driven by manufacturing. Excluding manufacturing, non-residential structures are fading slightly, whereas manufacturing is build out is probably the strongest it's been in a generation or two. It's being led by investments in computers and electronics. In particular, if we think in terms of we've had to rebuild semiconductor facilities because we cannot rely on China, that kind of reshoring is in fact taking place with three major ones underway. Similarly, if you have to worry about electric vehicles and the battery supply, and the desire to put that in place domestically is also fueling that. Now, retail trade. For us, our retail trade was the strongest in 3 years based on our sales tax collections. We're expecting, in this case, fading to about 2,724. Oops, misplaced. Overall, U.S. retail sales were up about 2.5% over the prior year, but there is a divide. Just like I was explaining before, if you were in those sectors that were booming coming out of the pandemic, that's where you're seeing the fade. In this case, building materials, garden supplies, home furnitures, household appliances. On the other hand, electronic shopping is doing really well. Restaurants and bars are doing really well. Auto dealers are doing really well. And in particular, you'll notice retail sales, excluding restaurant and bars, is lower than the overall total. We see roughly the same thing here. Where we're seeing the gains is in auto deals, electronic shopping, restaurants and bars. Home furnishings, electronics, sporting goods, building materials are all down over prior year. Suggesting if we think of that consumer pattern, depending on where you're serving all those industries, that can have the rattle-on effects for a manufacturer. Now, relative to mixed signals, I'm characterizing U.S. manufacturing as the poster child for mixed signals. Overall, manufacturing production remains above pre-pandemic levels, but it's been fading slightly over the course of and consistently over the last year. It's down about 1.7%. Some of that was strike related relative to UAW against the big three, but excluding motor vehicles and parts, manufacturing production was still down about 1.4%. It depends critically again on your industry. Overall, durable goods production is down slightly, but you have big gains in computers and electronics and huge gains in the aerospace industry. Everybody else was down slightly to down in a big way in the case of furniture. Motor vehicles is affected by the strike. And non-durable goods production is down slightly. Basically, petroleum, petrochemical, and chemicals was up, but way down in plastics, apparel, printing, modestly otherwise. Overall, manufacturing orders are basically sliding. It's up only 0.5% so far this year. It's down compared to where it was in October last year. But the durable goods orders is actually up both year over year and year to date. Durable good orders excluding transportation is up about 1.3%. And here's where we get the divides on durable goods. That's actually running slightly stronger. All manufacturing new orders is up only a tad. Durable goods orders up almost 4%, with some gains in machinery, but fall-offs in furniture, primary metals, big gains in transportation, which is both autos and aerospace. Aircraft, of course, are having to be reordered as the airline industries discover the surge in demand for travel all over again. Even within particular sectors, you are getting mixed results. Primary metals, for example, is down, but that's largely because aluminum production on primary metals is down. Foundries is actually doing quite well. On the machinery side, which seems to be almost break even, big drop in farm implements, a sizable drop in industrial, but construction equipment demand is way up. HVAC is still up. Turbines and generators and material handling is still way up. On computers and electronics, it's actually substantial in both on the computer side and defense navigation, slightly on electromedical diagnostic equipment, but down in communications equipment, figuring cell towers, phones, down in components. On the transportation side, while that looks really good, it's not motors and vehicles, parts and trailers, which is reasonable. It's up 4%. The big surge is in aircraft and defense aircraft in terms of new orders. So if you happen to be a supplier to the aircraft industry as an OEM, you're doing quite well. Overall shipments see the same pattern. Shipments are down in wood products, primary metals, I have to fix it, but up in machinery, computers, electronics, electric equipment, transportation. For non-durable goods, you're down slightly, mainly textiles, petroleum products, and since this is in dollar amounts, certainly plastics, but paper, printing, chemicals, food products are all actually generally flat. Overall, total manufacturing sales are down from record highs, but still well ahead of pre-pandemic levels. Net income is facing challenges both because of declining sales and cost pressures. All of this divide actually carries over to employment. This is U.S. manufacturing employment. As I highlighted before, durable goods orders were up. And again, if we look at where it's up, non-durables is down. On the durable side, it's down in wood products, furniture, miscellaneous. Basically pretty solid in most places, but way ahead in transportation. And if you actually write it down into true aerospace and that being spacecraft, that's actually been building up substantially as well. On the non-durable side, food is doing real well in terms of gains in employment, beverages as well, but textiles, apparel, paper, chemicals, plastics are all down. I would say I almost did the one for Wisconsin. We're actually doing, I think, reasonably well compared to all of this. We are getting the gains in food, but relative to the percentage gains in most of those, we're basically pretty flat in most cases, suggesting our performance is probably better than the overall pace of the U.S. as a whole. In terms of job openings for manufacturing, they've actually retreated, understandably, but it's still way ahead of pre-pandemic levels. The pre-pandemic levels was 400,000 nationwide. We're still almost a good 40% higher than that, even with the retreat compared to where we were a year ago. And that's true in both manufacturing for durable and non-durable industries. All right, Wisconsin economy. What we do. This chart compares our shares of real GDP by industry compared to what is the U.S. average, so that if it's in red, we have less of it than the U.S. as a whole. If it's green, we have more of it. Roughly speaking, we have a larger private sector than the U.S. We have a smaller government sector. We have a huge edge in manufacturing compared to the rest of the country, but it extends to insurance, healthcare, agriculture. Mining, information, professional services, not so much. On the mining side, to the best of my knowledge, there's no oil rigs operating in the state of Wisconsin. For Wisconsin manufacturing, overall, we're 7th among states for manufacturing employment. We've been gaining employment coming out of the Great Recession. That's not true everywhere. Those states in red actually were losing even after the recovery started coming out of that environment. For us, we're at about 478,000 manufacturing jobs. That's slightly ahead of where we left off pre-pandemic, but basically, again, almost moving sideways, what I would characterize as a slow fade. Relative to that increase in manufacturing value that you saw nationwide, it is the East, North, Central states, and that does include the state of Wisconsin, that is leading the value put in place in terms of as we do the reinvestment in reshoring or just building up domestic industrial capacity. Overall, skip that. For us, in the state of Wisconsin, we've had the strongest increase in manufacturing property values in 40 years. In part, our exports have actually held up. While they've basically started slowing down, we had a huge increase in 2022 at 10%. Even through September, we're up 2.2% compared to prior year. If there is a risk factor for us in manufacturing, it's the cost of electricity. We have the second highest electricity costs in the Midwest. All right, housing and construction. Construction employment in Wisconsin has been sort of building. We've been hitting record highs after record highs. As of September, we still had another record high, and it's the divide that, much as I highlighted, it was the gain in spending on infrastructure. It's the build out of heavy and civil engineering projects that's really driving it. Overall construction and building is flat, and in the residential side, down slightly. Overall, for the state of Wisconsin, existing home prices are still rising, but sales are falling because of reduced supply. If you have one of those mortgages that are below 3%, you're loath to move to refinance to a newer property at 7%. The financing just isn't there. Overall, our pace of housing construction has faded, but it's still slightly ahead of pre-pandemic highs and way ahead of the 2019 average. What affects house price affordability is the state of Wisconsin's relatively affordable. The West Coast, the East Coast, South Florida are not. Relative to shares of income necessary to afford the median valued home, anything under 3.5 would be positive. We're generally in the 2.5 to 3.5 range. But that also means that because we're more affordable, we're actually seeing stronger gains in home appreciation than the U.S. right now. Indeed, as of September, we had the 7th highest increase in home values in the country. Basically, any place in red is below 3%, which would be not increasing in real terms. You can see roughly that's the West. We've had strong property value gains across the entire state. And if you'll notice the Packard color scheme here, only those counties that have in gold had increases in property values exceeding 15%. If you're green, it was over 10. Even those in white were practically 10%. Almost every market had double-digit increases in 2022. At this stage, we are seeing even some of those double-digit increases maintained, particularly in Fox Valley area. But every metro area in the state of Wisconsin is having home prices increasing faster than the U.S. average. Now, our labor markets. I'm probably going to have to move a little faster or skip this really quickly. Wisconsin, what gives Wisconsin the edge is Wisconsin workers are more engaged than the U.S. average by gender or ethnicity. It is also true at age group. What I am particularly encouraged by is the youth overall labor force participation rate, particularly among teenagers and the young. We're way ahead of the U.S. average. But it's really adequate, it's really profound, is the prime working age population. We have the 6th highest labor force participation among the 25 to 54-year-old age group. Where we get a big edge is actually women. Our women's labor force participation rate relative to the U.S. average is stronger than the men's. And we have ranked overall about 9th for employment population for married women, 7th overall for both working parents. Well, if you haven't engaged, okay, I'll get to those. In 2022, Wisconsin set a new record low for its annual unemployment rate. We topped that by April 24, where we hit May 23, where unemployment rate dropped to about 2.4%. The unemployment rate has started drifting upward, but it's not because of employment losses, it's because we're getting stronger gains in labor force participation. Every metro area in the state of Wisconsin has an unemployment rate below the U.S. average. The number of persons actually being unemployed hit a new record low in April 2024. Right now, it's about 100,000. But again, that's basically people coming off the sidelines or deciding to re-enter the labor force. We're actually getting gains in overall employment and in private employment through. Where we are lagging depends on industry and the divide. Largely, for us, the lag is on the government sector and hospitality, which of course was related to restaurants trying to restaff after being shut down for so long. Our labor shortage at this point is about 126,000. We have 223,000 job openings, suggesting, again, it's not necessarily a lack of labor demand. It's just the search is starting under the overall. If we take the number of persons unemployed less the number of job openings, we have about 126,000 jobs open that could not be filled, even if everybody was in the right spot, right skill set, right industry. And in terms of where we would track our labor market indicators by just who's on unemployment rolls, they are still extremely low. Right now, for the second week of November, at about 17,000, continuing claims more recently at about 20,000. That is actually below this point a year ago. Income. Well, if you have both parents working and a high labor force and participation rate, generally speaking, that's going to result in a larger middle class than the U.S. average, and we see that, particularly in the family distribution. But we have this lovely property of we have below average cost of living, with the result that our median family income is actually way ahead. It starts at the U.S. average, slightly ahead, but it's way ahead as soon as you adjust the cost of living, almost 10% ahead of the U.S. average. For first quarter, we were 19th for income growth, but we couldn't carry that into the second quarter. I highlighted at the beginning that one of the major sectors that we have in terms of gross domestic product relative to the U.S. is actually agriculture. We actually in second quarter had probably the worst quarter for farm income we've had in over 20 years. That actually adversely affected personal income growth in the state of Wisconsin, and in terms of gross domestic product, the weakness in the farm side actually drove us negative in slightly second quarter compared to the first quarter. But if you could set aside the agricultural side and set aside the government side, private non-farm income GDP was exactly the median state level. This is, of course, why agriculture can have different results at short notice. All right, poverty and income equality. Overall, we have the fourth lowest poverty rate in the U.S., third lowest among children. But if we think in terms of the second overall poverty measure on a supplemental basis, which will include all of those efforts to relieve poverty, we have the second lowest rate in the country. We're also one of the top states for health insurance coverage. State and local tax burden has reduced significantly over the years. We're now in the situation we are below the U.S. average. It's percentage personal income. As witness, compare ourselves to what is California, Minnesota, Illinois, well below. And we have a situation we're more competitive for businesses. We're ranked about 39th for business taxes, and we will top that. As one of those initiatives I highlighted to deal with the surplus, the state of Wisconsin has now fully exempt business personal property tax. We are among those states, the ones in green, that do not tax business personal property in any way. All right, net migration. We've had positive in-migration in 2022. Principal sources of in-migration are Illinois, Minnesota, and California. And you can see basically where they're moving to. Basically, right around the exurbs of the Minneapolis area in northwest Wisconsin is where you're seeing some of the big gains in population. Also true in the Fox Valley and sort of the exurbs of Minneapolis. Who is moving in is the next question. This compares the number of children of a certain age compared to the number of children of that same cohort 2 years earlier. So how many 3-year-olds do we have relative to 1-year-olds? We've actually gained population among children, particularly young children. And generally speaking, if children move in, they take their parents with them. So we're getting gains in the early 30s as well. All right, Wisconsin entrepreneurship, it's surged coming out of the COVID contraction, and I'm pleased to say it has not faded. The overall number of businesses have risen sharply in 21, 22, and 23, with strong growth in businesses operating in the ground in most of the state. Only basically a pocket in the north of Highway 29, but not close to the northwest sector. All right, U.S. outlook. I come back to this, which is the Federal Reserve's flight path. This is where they're expecting growth to be. They would expect real growth to slide in 2024, unemployment rate to creep up slightly. They're presuming success in the inflation rate of about 2.6%, and that's a core measure. We're not there yet, obviously. Where they're also expecting real GDP to be in that 1% territory. Translation, you will see a slight decline in manufacturing industrial production compared to last year. For our outlook, we're basically going to follow the same pattern, a moderation of growth, roughly about 2% this year, which if I did that non-farm private sector calculation, it's right about where we're at. We're expecting to be somewhat slower in 2024. Overall, that has the result of the unemployment rate is down, will creep up slightly, but we're expecting it to remain way below 4% even through 25 and 26. As a result of that, we expect overall employment to continue to expand through second quarter 2024 and stabilize at that level. Manufacturing employment fits roughly that same pattern where we're seeing a slight fade through sort of mid next year. And that compares to the overall 2024 slightly less. Personal income growth, we're expecting wages and salaries this year to be about 5%. Will slow down to about 4% next year. And regionally, you'll see much the same patterns. We're expecting modest growth rate in employment for all metropolitan areas. But for example, Eau Claire would be stronger than La Crosse or Appleton, in part because they're sort of rebounding. Appleton had a stronger start to begin with. Wage and salary growth follows roughly the same pattern. Most areas will be seeing about a 4% growth in wages and salaries. All right, your key takeaways from all of this is, as self-evident, I think there are significant cross currents in the economy. It depends critically, again, on what industry you are in and where you're at relative to recovery from the pandemic. In any case, a single data point will not reflect the situation in your industry, your region, or your location. The advice I give everybody is trust your own order book. Don't be misled as to what the business press is telling you. Your order book is more informative. The other of which is know your financials. If you do have, for example, balloon loans coming due, you do need to know whether or not what you can do for the refinancing or restructuring of that. And as a long-term basis, it's always good to do a financial stress. In the face of an uncertain economy, if you can think back on what are your more difficult circumstances, could you withstand it? It's worth a check to see whether or not you can make that progress. All right. That was faster than I wanted to, but I'm respectful of your time. And at that stage, last point. Best presentations can be put into a 2x2 Post-it note, and this is it. Basically, for 2024, you're looking at a growth rate that's slower than the current one, unemployment rate rising slightly, inflation rate fading, federal funds rate will still be at about 5.1. And if you're paying close attention, that is exactly the Federal Reserve's outlook for 2024. All right, now I'm done and open to questions.